The next method for estimating the uncollectible accounts is the aging of receivables method. In the aging of receivables method, we recognize that the older an account is, the more likely it's going to be uncollectible. So we separate out our accounts receivable into the number of days that it is past due. And then we give each section of days a different percentage uncollectible amount. So when we're trying to estimate the balance for our allowance of doubtful accounts, we would take our amount of accounts receivable times the percent uncollectible. So our accounts receivable times the percent uncollectible. And we can copy that formula all the way to the end. So our total allowance for doubtful accounts needs to be the sum of all of those estimated amounts. So the balance of our allowance for doubtful accounts needs to be $11,820. Now we have our adjusting journal entry. So we need the adjusting entry to record our bad debt expense and a credit to allowance for doubtful accounts, assuming that we already have a $3,600 credit balance in allowance for doubtful accounts. So we need that credit balance to be $11,820. So we need to record a credit of $8,220 to our allowance for doubtful accounts to get that ending balance to be $11,820. The next question says, what if instead we had a debit balance? Well, again, we need to record whatever happens to get us a final balance of $11,820. So in order to do that with a $100 debit balance, we need our transaction to be for $11,920. This example looks at several different transactions related to notes receivable. So we have a company and we offer notes receivable in payment of overdue accounts receivable accounts. On December 13th, we accept the $9,500 45-day 8% note in agreement with our client in payment for her accounts receivable. So we're going to record a notes receivable a debit of $9,500 and we're going to credit her account receivable. On December 31st, we need to prepare an end of the year adjusting entry to record accrued interest from December 13th to December 31. So we need to calculate how many days we had between December 13th and December 31. So the days on the calendar are 18 days. We would record interest receivable and interest revenue. So the interest calculation is the amount of the note, $9,500, times the rate, 8%, times time. In this case, we want 18 days. So 18 divided by 360. So our interest revenue, $38 for our adjusting entry. On January 27th, we received full payment for that 45-day note. So we are going to receive cash. We're going to remove that interest receivable of $38. We're going to record interest revenue, and we're going to remove our note receivable. So our note receivable was $9,500. Now 27 more days have passed. So we need interest revenue. We need to take our note amount, $9,500, times 8% times 27 days divided by 360 days to give us interest revenue of $57. Our cash received is the sum of all three. So we received $9,595 in cash for that note. On March 3rd, we accept a $5,000 90-day note on the past due account of Tomas Company. So we record a notes receivable and remove the accounts receivable of Tomas Company. So we have a debit of 5,000 and a credit of 5,000. On March 17th, we accept a $2,000 30-day note. So we're going to record a notes receivable and remove our account receivable for that customer for $2,000. On April 16th, this note is due and our customer did not pay it. So when they dishonor their note, we have to restore that note, accounts receivable, we're going to remove the note receivable, and we're going to add interest. So we have the note receivable of $2,000, and the interest revenue on that is $2,000 times 9% times 30 days. 30 days divided by 360 days. So we have $15 of interest. On May 1st, we write off that account against allowance for doubtful accounts. So we're going to record a debit to allowance for doubtful accounts and a credit for that accounts receivable. On June 1st, we received the payment for that Thomas note. So we received cash. We're going to have interest revenue, and we're going to remove that note receivable from our books. So that note was for $5,000. It was a 10% 90-day note. So the note is for $5,000. The interest revenue is $5,000 times 10% times 90 days. Or $125. So we receive cash of $5,125. The last example that we're going to look at is accounts receivable turnover. So accounts receivable turnover is a measurement of how many days it takes for our customers to pay us. So first we're looking at year 2, and then we'll look at year 3. So in year 2, the calculation for accounts receivable turnover is sales divided by average accounts receivable. So for year 2, we would take year 2 sales divided by year 1 sales plus year 2 sales divided by 2. That's average accounts receivable. And for year 3, we would take year 3 sales divided by year 2 accounts receivable plus year 3 accounts receivable divided by 2. So what we have is these are the number of days outstanding for our accounts receivable. So on average, it takes 7.77 days for our customers to pay us. And in year 3, we've moved up to an average of 10 days. Now, what we would do then, we assume our competitors have a turnover 11. So one, we would compare ourselves to our competitors. And are we doing better or worse than them in collections? We're doing better in collections. The next thing we would use this ratio for is to determine if we're getting better or worse at our own ability to collect money from our customers. Well, we can see that this is getting worse. We've added 2.5 days roughly to our collection. So this is something that we would want to look at, because the longer it takes customers to pay us, the more unlikely it is that they are going to pay us, and we have less cash in order to pay our own debts. So if we have bills that come due, we don't have the cash available to us because our customers are taking longer and longer to pay us.